Hello everyone. Today we will talk about sources of debt financing. Debt financing serves as a temporary funding solution for businesses, as opposed to equity investments that dilute ownership by adding more owners. When a business opts for debt, it takes on a contractual obligation to repay the borrowed amount, along with interest, at a later date. This type of financing can be particularly challenging for startups, as institutional lenders often prefer established companies. As a result, many new entrepreneurs must rely on personal funds or utilize retained earnings, profits that are reinvested in the business, to generate necessary capital for growth. This practice, known as organic funding, is often the least expensive option available to growing businesses. For established small businesses in the United States, debt capital becomes essential for fueling growth, especially when internal cash flow is insufficient. It is estimated that small businesses collectively borrow around $1 trillion annually from various sources, including banks, family, friends, and credit cards. Despite the abundance of lenders compared to investors, small businesses often face significant hurdles in obtaining loans. Since the financial crisis of 2008, lending amounts have decreased markedly, making it increasingly difficult for small companies to secure funding. Although borrowing allows small firms to retain complete ownership, they must manage interest payments and carry this debt as a liability on their balance sheets. Furthermore, lenders generally view small businesses as higher risk investments, which results in higher interest rates. Despite these costs, debt financing can be more attractive than equity financing, as it does not require giving up a stake in the company. There are several compelling reasons for business owners to consider taking on debt. For instance, increasing the workforce or inventory can directly boost sales and help capture a larger market share. Additional capital may also be needed to purchase new equipment, which can enhance productivity and reduce operating costs. Refinancing existing high-interest loans can improve cash flow by securing more favorable terms. Additionally, taking advantage of cash discounts for early payments can further enhance financial efficiency. Establishing a strong relationship with lenders can provide long-term benefits, as a good repayment history can make future borrowing easier. Moreover, having access to financing before an economic downturn strikes can safeguard a business against financial crises. Sources of debt capital. Commercial banks. Commercial banks play a crucial role in the financial market, offering a wide range of loans to small businesses. They provide about 50% of the total dollar value of loans to small enterprises, making them a primary source of funding, especially as businesses grow. Most small business loans are relatively modest, with over 88% being for amounts under $100,000. The average micro-business loan is around $6,820, while loans between $100,000 and $1 million average about $245,775. Due to their conservative lending practices, banks prefer to extend credit to established businesses rather than high-risk startups. In fact, companies that have been in operation for less than 3 years are significantly less likely, up to 50% less likely, to receive loans compared to their more mature counterparts. Lenders are particularly concerned with a small business's operating history and its ability to produce stable cash flow, as this is essential for loan repayment. When evaluating loan applications, banks look for substantial owner investment, adequate cash flow, personal guarantees from entrepreneurs, and sufficient collateral. Small community banks, which account for nearly 98.7% of U.S. banking institutions, are often more flexible than larger banks and can customize loan terms to suit small business needs. They approve about 49.5% of small business loan requests, a stark contrast to the 17.3% approval rate at larger banking institutions. Short-term loans. Short-term loans, which are typically extended for less than 1 year, are among the most common forms of financing banks offer to small businesses. These loans help replenish working capital for purposes such as inventory purchases, financing customer credit sales, and seizing cash discounts. Small business owners often repay these loans by converting inventory and receivables into cash. The basic form of short-term loan is a commercial loan, which is usually unsecured. Owners typically repay these loans within 3 to 6 months, sometimes prepaying the interest, which is deducted from the total loan amount. Another significant option is a line of credit, which provides businesses with a pre-approved limit of cash for their operational needs. Business owners can access funds quickly and conveniently throughout the year, with banks often requiring that the line of credit maintain a zero balance during certain periods. While small lines of credit are often unsecured, larger ones may be secured by business assets. However, obtaining a line of credit can be challenging, especially for newer businesses, as evidenced by a study indicating that only 37.6% of small business applicants successfully secure one. Intermediate and long-term loans. Although banks primarily provide short-term capital, they also extend intermediate and long-term loans for durations of 1 year or longer. These loans are used for significant investments, such as starting a business, purchasing real estate, or acquiring equipment. Repayments on these loans are typically made on a monthly or quarterly basis. Among these, term loans are common, with banks granting them based on a business's operating history. These loans often come with specific covenants, which can limit the owner's financial decisions, such as setting salary caps or prohibiting additional borrowing without approval. Installment loans are another variety offered by banks, specifically for purchasing fixed assets, including equipment and real estate. Depending on the asset's value, banks may lend 60 to 80% for equipment purchases, and typically up to 75 to 80% of a property's value for real estate loans, often with longer repayment schedules of 10 to 30 years. Understanding the full terms and conditions attached to these loans is vital for entrepreneurs to ensure they make informed borrowing decisions. Non-bank sources of debt capital. While banks are often the primary source for entrepreneurs seeking debt capital, various non-bank options are available that can effectively meet financing needs. These alternatives provide businesses with the necessary funding to grow and thrive. Asset-based lenders are typically smaller commercial banks or specialty finance companies that allow businesses to borrow against idle assets, such as accounts receivable, inventory, or purchase orders. This type of financing is particularly beneficial for companies with significant tangible assets but limited cash flow. Asset-based lenders prioritize the quality of the collateral over credit ratings, which means that even unprofitable companies can secure loans based on their assets. The amount a business can borrow often depends on the advance rate, or the percentage of an asset's value that can be claimed. For example, a company with $100,000 in receivables might negotiate a 70% advance rate, resulting in a $70,000 loan. Another critical source of financing is trade credit, which involves agreements with suppliers to receive goods or services without immediate payment. Approximately 60% of small businesses utilize trade credit, which effectively provides interest-free, short-term loans. Successful relationships with suppliers are crucial. Businesses need to maintain a reliable payment history to build trust and creditworthiness over time. Equipment suppliers often provide financing options that resemble trade credit, enabling businesses to pay for necessary equipment over an extended period. Typically requiring only a modest down payment, suppliers allow businesses to finance purchases while benefiting from operational equipment right away. This flexibility can be particularly helpful for startup companies needing essential fixtures to launch their operations. Commercial finance companies serve as another option, especially for businesses that might be denied bank loans. These companies are willing to accept greater risks and typically require collateral to secure their loans. They generally offer quicker turnaround times and flexible payment plans compared to traditional lenders, albeit at higher interest rates. This approach provides a vital funding source for cash-hungry businesses. Stock brokerage houses can also provide loans to entrepreneurs, typically against the stocks and bonds within a client's portfolio. Known as margin loans, these often feature lower interest rates and flexible repayment schedules. However, there is a risk involved, as brokers may issue margin calls if the value of the collateral declines, demanding more cash or securities. Insurance companies offer valuable lending options for small businesses, particularly through policy loans that entrepreneurs can take against the cash value of their life insurance. Policy loans usually allow borrowing up to 95% of the cash value at favorable interest rates, with flexible repayment terms. Additionally, insurance companies extend mortgage loans on real estate, providing long-term financing with terms that do not excessively burden the firm's cash flow. Credit unions are non-profit cooperatives that can provide business loans, often at lower rates than banks. While they may limit the loan amounts compared to larger financial institutions, credit unions emphasize member service and can offer advantageous terms for small business owners. In terms of bonds, while traditionally associated with large corporations, they are becoming a viable funding avenue for small businesses as well. Various bond types, including convertible bonds and industrial development revenue bonds, enable companies to raise necessary capital while adhering to regulatory requirements. Private placements present another option, where businesses can sell debt to a small number of investors, often tailored to meet specific needs. These typically feature fixed interest rates and longer maturities than traditional loans, making them suitable for small businesses. Finally, small business investment companies, SBICs, provide a public-private partnership model, allowing for both debt and equity financing. SBICs focus on small businesses, often providing larger investments with favorable terms that can support startups and established firms alike. Federally sponsored programs. Federally sponsored lending programs have experienced budget cuts in recent years, indicating a trend toward reduced government involvement in lending. Nonetheless, many programs are still operational, and some are even expanding, providing crucial support to businesses. Okay, now Economic Development Administration, EDA. The EDA, under the Commerce Department, provides grants, loan guarantees, and loans to create and expand businesses in economically distressed areas. The EDA can guarantee up to 80% of loans ranging from $750,000 to $10 million, minimizing risk for private lenders. Both startups and established businesses must contribute equity, 15% of the guaranteed amount to qualify. Loan proceeds can be used for various purposes, including working capital, equipment purchases, and renovations. The EDA also offers revolving loan funds for communities facing high unemployment, providing local businesses with accessible financing. Department of Housing and Urban Development, HUD. HUD facilitates several loan programs, particularly through Community Development Block Grants, CDBGs, which provide cities with funds for local entrepreneurs. These grants aim to invigorate local economies by supporting small business startups and expansions. HUD also offers loan guarantees through its Section 108 program, which converts CDBG funds into larger, federally guaranteed loans for revitalization projects. Since 1978, this program has supported over 1,200 projects, helping communities benefit economically. U.S. Department of Agriculture, USDA. The USDA aids small businesses in non-farm sectors through its Rural Business Cooperative Service, RBS, focusing on rural areas with populations under 50,000. The RBS provides nearly $900 million in loan guarantees each year, covering up to 80% of loans issued by private lenders. To qualify, businesses must demonstrate employment benefits in their communities. RBS also offers grants to stimulate small business growth. Small Business Innovation Research, ESPR, Program. The ESPR program provides funding across 11 federal agencies, with a total budget exceeding $2.1 billion annually. It supports small businesses in R&D without requiring them to give up equity or incur significant debt. The program consists of 3 phases. Phase 1 grants test feasibility, up to $150,000. Phase 2 grants develop prototypes, up to $1 million. And Phase 3 focuses on commercialization. Competition is fierce, with only 17% of applicants receiving funding. Successful companies often achieve significant commercial growth, contributing to innovation. Small Business Technology Transfer, STTR, Program. The STTR program complements ESPR by fostering partnerships between small businesses and research institutions. While ESPR targets ideas generated within small firms, STTR allows researchers from universities and non-profit institutions to collaborate with small businesses. Grants are awarded in 2 phases, with a budget of approximately $1 billion annually, supporting innovative research partnerships. The Small Business Administration, SBA, is a U.S. government agency dedicated to supporting small businesses, especially those that struggle to obtain funding through traditional loans due to limited assets or high risk. SBA programs are vital as they help many startups and existing businesses secure financing to launch and grow. Despite facing criticism for occasionally diverting funds to larger corporations and concerns about mismanagement, the SBA enjoys strong political backing because of its critical role in fostering entrepreneurship and economic development. In 2012, the SBA guaranteed over $30 billion in loans for more than 47,000 small businesses. Due to the financial market turmoil in 2008, banks adopted stricter lending standards, making it more difficult for small businesses to get loans. SBA loan programs, though representing less than 10% of all small business loans, are especially important in these tight credit conditions. By guaranteeing a portion of loans made by traditional lenders, the SBA mitigates financial risks, encouraging lenders to provide loans that they might otherwise reject. To qualify, Businesses must meet the SBA's small business criteria and exclude ineligible industries like gambling and pyramid schemes. The application process can range from days to months, but expedited express programs offer responses within 36 hours. The SBA Express program allows participating lenders to use their own loan processes to provide loans up to $350,000, guaranteeing up to 50% of the loan. This program simplifies access for entrepreneurs who might struggle to meet conventional lending standards, though lenders set interest rates with some SBA-imposed limits. The Patriot Express program targets U.S. veterans and their spouses, offering loans up to $500,000 with higher guarantee rates and similarly fast processing times. Additional programs like Small Loan Advantage and Community Advantage extend capital access particularly to underserved communities by partnering with community-based institutions or supporting loans up to $350,000. The most popular SBA loan program is the 7A Loan Guarantee, which provides guarantees for loans as large as $5 million. Private lenders issue these loans, but benefit from SBA backing that reduces risk. This program is notable for its longer loan terms, often much longer than typical bank loans, offering advantages such as lower monthly payments. Entrepreneurs like Sheila Tucker and Craig Hartzell have successfully used 7A loans to start and grow businesses, demonstrating the program's importance in supporting competitive small firms. Other SBA programs address specific needs. The Capline program offers short-term working capital flexibility through various loan lines of credit supporting seasonal inventory, contract costs, and construction needs. The Section 504 Certified Development Company program provides long-term, fixed-rate financing for fixed assets such as land, buildings, and equipment, supporting economic growth while requiring job creation or public policy goals. Section 504 loans involve multiple lenders, including non-profit development companies, and typically require a modest down payment. For very small loans, the SBA's microloan program targets entrepreneurs requiring less than $50,000, often overlooked by traditional banks due to low profitability. These loans, made through non-profit intermediaries, offer manageable terms and aim to assist women, minorities, and low-income entrepreneurs. Additionally, the SBA supports small businesses engaged in international trade with specialized export loan programs that offer rapid approval and substantial guarantees for working capital and expansion. Finally, the SBA offers disaster assistance loans to help small businesses recover from natural disasters by providing low-interest financing to repair physical damage and cover working capital needs during the recovery period. This program plays a critical role in helping affected businesses rebuild after events such as Hurricane Sandy. State and local loan development programs have become increasingly important in financing business startups and expansions, especially as many federal programs face funding cuts. Instead of focusing on attracting large corporations, a strategy often referred to as chasing smokestacks, many states are now prioritizing support for small businesses, which tend to create more jobs and economic benefits locally. These programs come in various forms, including loans, loan guarantees, development grants, and venture capital pools, though applicants should be prepared for paperwork and potentially lengthy processes. A popular model among these programs is the Capital Access Program, CAP, which started in Michigan in 1986 and is now offered in 22 states. CAP incentivizes banks to lend to businesses that don't qualify for traditional loans by creating a loan loss reserve fund. Both the borrower and lender contribute fees to this fund, which the state then matches, effectively ensuring part of the loan against default. This arrangement encourages banks to approve loans they might otherwise reject. Studies show that over half of entrepreneurs accessing CAP loans would not have received financing without this support. Local governments also contribute significantly through revolving loan funds, RLFs. These funds, existing in more than 7,500 communities, combine public and private money to make small business loans, often at below market interest rates. As these loans are repaid, the funds are replenished and lent out again, maintaining ongoing support for entrepreneurs. Further, over 1,000 communities have established Community Development Financial Institutions, CDFIs. These entities focus on lending to entrepreneurs who don't meet conventional bank criteria, offering loans through mechanisms such as microenterprise and community development loan funds. Because CDFIs take on higher risks, they generally charge higher interest rates than traditional lenders, but they provide critical financial access to underserved business owners. Small business owners have various financing options beyond traditional banks and government agencies. One notable method is factoring accounts receivable, where businesses sell their outstanding invoices to a third-party factor. This allows firms to receive immediate cash rather than waiting for customer payments. The factor typically pays a portion of the invoice's value upfront, ranging from 50% to 80%, with a second payment issued once the customer pays the invoice, minus associated service fees. While factoring can provide urgent funding, it is generally more expensive than bank loans, leading many to view it as a last resort. Furthermore, factoring agreements can be categorized as either with recourse, where the business remains liable for uncollected debts, or without recourse, where the factor assumes that risk. Another significant financing method is leasing, which allows businesses to acquire assets such as equipment and office space without the upfront capital investment required for purchases. Leasing helps small businesses maintain better cash flow by spreading costs over time and avoiding the depreciation of owned assets. This approach is especially advantageous for startups and growing firms that need essential equipment without the financial burden of ownership. Cash advances serve as another alternative for businesses, particularly in sectors like retail and dining, where traditional receivables are not available. In this arrangement, a lender provides a lump sum that is repaid by deducting a percentage from future credit card sales. While this option offers quick cash, it carries high costs, making it suitable only as a final financing solution. The rise of peer-to-peer loans has also opened new avenues for small business financing. Online platforms like Lending Club and Prosper connect entrepreneurs with individual investors willing to fund their ventures. This method can provide quick access to capital, but interest rates can vary significantly, from under 7% to over 25%. The flexibility and community-driven nature of peer-to-peer lending have made it an appealing choice for many startups. Lastly, many entrepreneurs have made use of credit cards to launch their businesses due to their accessibility. However, this financing method is fraught with risks. High interest rates can burden business owners with significant debt, especially if the startup fails. Studies indicate a strong correlation between high credit card debt and increased chances of business failure, suggesting that while credit cards offer quick cash, they should be approached with caution. Where not to seek funds. Entrepreneurs in search of capital must be cautious of fraudsters who often target financially vulnerable small businesses. These scams typically begin when con artists identify desperate entrepreneurs seeking urgent financial assistance. Most schemes involve advance fees and usually follow one of two main patterns, although variations abound. In the first scheme, a scammer masquerades as a representative of a fake bank, claiming to offer a loan. The con artist assures the business owner that the loan is approved but requires an advance fee, often a percentage of the total loan amount, for processing. Unfortunately, the promised loan never materializes, resulting in substantial financial loss for the entrepreneur, sometimes amounting to thousands of dollars. Another prevalent scam involves a loan broker who entices small business owners with the promise of an SBA, Small Business Administration, loan. In this case, the broker requests a small processing fee upfront. Again, the promised loan fails to materialize, leaving the business owner out of pocket. Some scammers may also charge exorbitant fees for assisting with SBA loan applications. Such scams become more frequent during times of tight credit, particularly targeting the smallest SBA loan programs, like SPAY Express and microloan programs. The rise of the Internet has further facilitated these fraudulent activities. Scammers can establish fake online presences, approach victims anonymously, and disappear quickly to avoid repercussions. Their strategies are often smooth and well executed, making them difficult to detect. To protect themselves from these scams, entrepreneurs should exercise common sense and heed the saying, "If it sounds too good to be true, it probably is." Experts recommend several precautions. Be skeptical of unsolicited offers. Exercise caution when approached by anyone promising guaranteed financing. Watch for red flags. Be alert for indicators of scams, such as unsolicited listings for guaranteed loans or demands for upfront fees. Conduct background checks. Before engaging with lenders or brokers, verify their legitimacy. Check if they are registered to operate in your state and review any complaints against them via the Better Business Bureau. Consult legal advice. Always have an attorney review any loan agreements before signing. Avoid advance fees. Never pay upfront charges for financing, especially online, unless you have thoroughly verified the lender's credentials.
Thank you for watching. If you liked this video, please like and subscribe to channel.